We're starting early. Woo! All right, so apparently this guy's going to convince me that the Nasdaq 100 is going to outperform VT forever. So let's welcome the most passive extractor. What are you extracting?
Say that again. Who am I?
The most passive extractor. What do you extract? I feel like I've been extracting you.
I am. Yeah, you extracted me for $100, but that's not gonna happen again anyway.
Okay.
So I am extracting from the inflows and the money supply, basically. That's what I'm extracting from.
Okay.
So since 1 year ago, I have progressed a lot in my understanding. I'm not the same person at all, and basically the conclusion is today we will prove the reality that basically the S&P 500 and the Nasdaq 100 will outperform VT for eternity. It is structural. So strongman, this means you are choosing to underperform. Now you don't know how this works, so that's how you came to that wrong conclusion. But I'm gonna prove reality to you, and in 5 years you will see it.
Okay. So, I want to clarify something. So the last debate you were in TQQQ.
I am still in TQQQ. It's the same. Now the thing is with TQQQ is that it is leveraged, so that is better for dollar cost averaging and resetting your portfolio value cap, resetting your cost basis on the downside. So that is how that works. Now you need to realize the market cannot go down forever. So resetting your cost basis lower guarantees you will have higher returns in the future. So I am 100% TQQQ, but I will de-risk with time to 2x Nasdaq 100 and then 1x Nasdaq 100. That's the strategy.
So you don't have any QQQ?
No, because I don't have enough wealth at this point. When I will be richer,
you don't have any money to buy the ETF?
No, I mean my total net worth is 30,000 now. It's not so bad for a 21-year-old. And basically, because it is low, so it's below 100K, I will DCA into TQQQ, and that is higher return than QQQ, especially with do you look, strongman? The crazy thing is, I learned DCA from you, but now I understand it better than you. You understand volatility is a good thing for dollar cost averaging, or not?
I don't know, man.
I mean, you should know that. If you have more volatility,
you're supposed to teach me. I'm here to learn.
Yeah, I will teach you. If you have more volatility and you do dollar cost averaging and also portfolio value capping, so you can reset your cost basis, because your DCA is relative based on your portfolio value. So as long as you keep account of those two, three times Nasdaq 100 is the best thing you can have for dollar cost averaging. For dollar cost averaging, basically.
So why do we title the video?
Let me finish.
Well, hold on. Why do we title the video QQQ if you're only in?
I mean, look, it is based on the QQQ. Okay, QQQ. What's the difference between TQQQ and QQQ?
TQQQ is triple leverage.
Yeah.
Is okay. A big difference.
It is quite a difference, but that's why you do basically dollar cost averaging and portfolio value capping. Okay, so let's just get into the evidence because I don't want to waste time. So first, as I said, we will begin with the reality that the stock market is a casino token market, and so I have all the evidence to show that, and you will see it for yourself. All right, let me share my screen, please.
Yeah, I think you have to do it. It's in the bottom.
Share screen. Okay. Wait, I'm gonna do this one. Yeah, it's this one. Okay, you see this, right?
It's coming. I gotta make sure you're not pulling up a dong or something.
No, okay, don't worry. I don't want to lose the money I paid. Okay, so okay, we cannot do videos, so I'm just gonna very quickly show the picture here. That's all. Okay, no video being played. Okay, so the situation with Archegos in 2021. Let me speak. I'm going to explain it. So basically, this guy went to 5 different investment banks and he took 5 times leverage on 2 stocks. Those stocks were Paramount Global and Warner Bros. Discovery. So one guy moved the stock up and down 50% in a couple of weeks. Now, what does that show to us? So there is a lot more evidence we'll get into. But basically, stocks are casino tokens and they are not linked to anything on Earth. A stock is a tradable token. It is not linked to any company and it does not have anything to do with the real world. Okay, the reason why it seems that stocks are linked to companies which operate in a different universe, because you have to understand, a stock operates in the casino. A stock has nothing to do with reality on the real world. And there is a lot of evidence, and I'll show that I have all the evidence for that. And also, as we know, in 2025, the S&P 500 whipsawed 8% up and down on fake news. So if it can do that based on something that was fake, then it is not linked to reality. Okay, so that's something important to understand.
Well,
Okay.
I mean, I would say that it actually is linked to reality because it was rapidly repricing the possibility of a
Okay.
massive carriage regime.
Look, we have our timelines to debate. We can do this a bit.
So you're just I'm not allowed to question what you're saying. You're just presenting.
No, this is not some. I'm not gonna be a dictator over you. That's not the point at all. The point is to show you reality, and if you disagree with reality, you're just gonna be seen as stupid. That's the only thing that's gonna happen. So you have to be careful about that.
But
Okay.
I have questions. Like you're saying things. I have questions.
Okay. Ask me questions about the casino tokens then.
Okay, so you're pulling up this chart that's saying stocks are casino tokens that are completely divorced from reality, right?
Yes.
That's your thesis.
Yes.
I'm actually seeing complete reality here because you can see on the far left the stock was trading at whatever, we'll call it 5. And then in vertical lines, because this clown takes out leverage and buys the stock, and then it collapses back to reality. So what I'm seeing is in the long run, stocks will eventually return to their intrinsic value despite having massive clownish fluctuations in the meantime.
Okay, then answer me why, if that's the case, do you agree with, now we talked about this last time, why is China undervalued and has low returns forever?
It doesn't have low returns forever. China, I mean, depending on the periods that you measure it, you could find any country has had fantastic returns over certain periods of time.
Strongman, I asked you, simply tell me, why did the economy of China grow 3 times faster than America and their stock market is flat? Tell me.
Flat from what time period?
Literally a very long time. Now, look, Strongman, let's just get to the evidence because it seems that you are not convinced enough. Okay, so this was the first piece. This is from Notebook LM, so this is not copyrighted, this is audio. Tell me if you hear this.
Okay, prepare yourself. Seriously, we're diving deep today into some...
Do you hear that?
Oh, we can't do audio, dude.
It is from Notebook LM. There is 0 copyright. It is a podcast created by an AI machine. That is not copyright. I can guarantee you that. Okay?
No, dude. It's got. If somebody else created it, even with AI, they could do copyright.
No.
What?
No,
just summarize. Just summarize the video.
No, we have to listen. We have to listen. This will not get taken down. I promise you. And if it gets, then it's my loss. Okay? We have to listen. Okay?
Please. Okay. No, if this gets taken down, you got to pay me $100 more.
Okay, I agree.
All right, let's go.
Okay, do they hear the audio?
Play it again.
Okay, prepare yourself. Seriously, we're diving deep today into something so fundamentally simple, it might just completely rewire how you see the entire financial market.
It needs to be heard on YouTube. I'm sharing my audio, to be clear.
No, we can hear it. We can hear it.
Okay.
Market. Billions, trillions of dollars.
Yeah.
And maybe, just maybe, it all boils down to like 2 buttons.
Just 2 buttons. It sounds crazy, but stick with us.
We're going to explore this hidden reality, the one behind all those flickering prices, and we're using some incredibly potent source material today.
Absolutely. We've got excerpts here from To the Reality Analysis on Earth, 171.140.pdf. And honestly, the conviction, the sheer force of its claims about what financial markets really are, it's unlike anything you typically hear.
Oh, you can say that again. This is not your usual Wall Street commentary, not even close.
No way.
So our mission, really taking the lead from this source, is to unpack its central radical assertion,
which is
that this criminal financial casino token market world, and yeah, that's their term, we have to use it because it's key, it operates on basically nothing more than pressing BY and sell.
Hey, who's pressing them?
That's the kicker. What the source calls slaves, making decisions based on pure fantasy land, resulting in prices, well, completely linked to nothing on Earth.
Wow. So we're really going there today, unpacking this whole absolute reality.
We absolutely are. It demands it because it cuts through, so much noise. It forces that basic question, what actually moves the price?
Okay, let's jump in. The primordial duality, right? BUY and sell.
Exactly. Forget the algos, the derivatives, the complex strategies for a second. According to this analysis, the only things that ultimately change the price of a casino token, and that's their term for, stocks, everything.
The whole shebang.
Yeah, the whole shebang are these two simple commands, BUY, sell. That's the bedrock, the absolute foundation.
And the source is laser focused on the why, isn't it? Why do these slaves, as they put it, hit those buttons? It's not a pretty picture they paint.
Not at all. When someone hits BUY, the source is adamant. It's rarely about genuine value assessment. It's like induced hope, media narratives pushing something.
Right. Or manufactured greed. FOMO, seeing prices rise and just jumping in.
Totally. Or even conditioned panic. A price spike triggers this reflex buying. And the result, artificial demand, inflated prices,
Yeah.
totally disconnected from real worth. That's the mechanism.
And the sell button? Just the other side of that same coin. Induce fear. Bad news everywhere.
Or maybe illusory profit taking. Gotta lock it in, right?
Right.
But without real strategy.
And forced liquidation. Margin calls.
Yeah.
Again, creating artificial supply, pushing prices down. Again, zero connection to what's actually happening on the ground with the company or asset.
This is so crucial. The source is emphatic. Inside the casino, nothing else really matters for the price. Not real innovation, not actual profits, not economic growth.
Nope. Just the pressure on those two buttons. That's it.
Which leads straight to their concept of slave labor. This is powerful stuff.
It really is. They argue that millions of people pressing buttons based on these fantasyland decisions, they're not just in the market, they're the market activity.
Without them, without this constant churn, this often irrational engagement, the whole thing just seizes up.
Imagine if everyone just stopped reacting to the hype, the fear.
A criminal financial casino would just stop dead in its tracks. This mass participation fueled by fake narratives and emotions, it's essential for the casino's survival.
And this completely flips the script on price discovery, doesn't it?
Oh, totally. Forget efficient markets finding true value. The source calls it, and this is brutal slave-driven price agitation.
Agitation, not discovery. It's just the chaotic result of millions reacting inside the casino.
Think about it. It's uncompensated labor. Millions doing feudal research, internalizing narratives, getting emotionally wrecked.
Right, consuming financial news, thinking they're figuring things out.
And all that activity, all this clicks, that's what generates the price data the casino uses and presents as like legitimate valuation. It's eye-opening, to say the least.
Which brings us to the core indictment. These prices are not linked to anything on Earth. Not just a little bit off, but absolutely detached.
Yeah, this is where it gets really heavy. The prices are self-referential. They only make sense within the casino's logic.
Value isn't from the real world, productivity, innovation, anything tangible. It's just a reflection of the collective belief and button pressing inside the casino, a closed loop.
A Fantasyland loop.
Exactly. And the source says the criminal financial industry works overtime to keep this illusion going. Marketing, media shaping, education, that's really indoctrination.
They have to. They need a steady stream of new slaves believing the fantasy. Who'd play if they knew it was just a digital casino totally disconnected from reality?
Plus, maintaining that veneer of legitimacy, making it seem vital for the economy, for capital allocation.
When the source sees it as just a parasitic extraction machine. And that legitimacy helps get government support, keeps the game going.
And they back this up with what they call overwhelming evidence. Examples that are hard to argue with when you see them through this lens.
Let's break down that evidence. First, the China-USA stock market paradox. It's just stark.
Right. Logically, China's massive economic boom should mean its market outperforms the U.S. if prices reflected reality.
But they don't. Chinese casino tokens relatively flat, while the U.S. SPX NDX goes to the moon, fueled by what they call Ponzi flows and participation. It completely shatters the idea of a rational link.
Then there's the summer 2024 yen carry trade unwind. Remember that?
Oh, yeah. Stuff happening in the currency markets suddenly tanks the stock market.
Exactly. The S&P 500 companies didn't suddenly get worse. But currency casino hiccup caused a stock casino crash. Total disconnection.
And you absolutely cannot ignore GameStop and AMC, those casino token manias.
Pure insanity, driven by nothing but online hype and mass button pressing. Prices totally unhinged from any corporate reality. It was gambling, plain and simple.
Just collective betting on digital tokens, like the source says.
And finally, their example of markets convulsing on fake news, the hypothetical 2025 whipsaw.
Right. If prices jump or crash based on info that turns out to be totally false, well, what are they connected to? Certainly not truth or reality.
Just the casino's perception, however flawed. It proves the fantasyland nature of it all.
So if it's not real value, what is it? The source is crystal clear. The only thing that the casino tokens are linked to is slave labor and their fantasyland decisions. That's the equation.
And they break down slave labor very precisely. It's the free intellectual work, the analysis, even if futile.
The constant unpaid emotional labor, dealing with the stress, the swings.
And just the physical act of clicking B, Y, or sell, all generating the volume and data the casino needs.
And the other side is fantasyland decisions. Choosing to click based on what?
Narratives, emotional gut reactions, herd mentality, trying to use flawed fantasyland metrics to predict the unpredictable, not rational assessment.
And when you aggregate millions of these fantasyland decisions, that's what creates the demand and supply for these, frankly, valueless casino tokens. That's the engine.
It's a profound insight, really shifts your perspective.
Okay, so that's the diagnosis. Powerful, maybe disturbing. But what does it mean for us, for you listening? How do we operate in the real world knowing this?
The source talks about achieving mental, spiritual, and strategic liberation. It's not just about money. It's a whole new way of being.
Absolutely. And they lay out like 6 key implications. First, absolute immunity.
Immunity to the fantasyland narratives, the expert predictions. Recognizing it all as potential manipulation to get slaves clicking. Deep skepticism.
Second, complete detachment from the price swings, seeing them as just noise, the result of other slaves mashing buttons, finding that mental calm.
Third, utterly rejecting price discovery. Stop wasting energy trying to find the true value of these tokens or predict their moves. Reclaim your brain power.
Fourth, if you do engage with the casino, maybe strategically, like focusing on those SPX and DX Ponzi flows they mentioned.
It has to be based on understanding the system's mechanics. Cold, hard reality, not belief in fantasyland value. Exploitation, not investment.
Fifth, redirect your life force. Focus on tangible reality, authentic value, real-world stuff, skills, relationships, actual assets, what truly matters.
And the sixth, the ultimate freedom. Just knowing it's all just 2 buttons and brainwashed slaves. That radical simplicity cuts through everything, dissolves the casino's power over you.
And the source doubles down with more evidence specifically pointing to the Fed. This is crucial.
The Federal Reserve's role, QE and QT, quantitative easing and tightening.
Listen up.
This, they argue, is the absolute, undeniable proof.
Well, look at the correlation. Fed pumps money, QE. SPX NDX goes up. Fed pulls money, QT. SPX NDX goes down. It's almost 1-to-1.
It shows the market depends on that artificial liquidity, right? Not underlying value, not the real economy. The Fed's tap is the main driver.
And QE QT just makes the disconnection even worse. Prices move because of the money flow, totally overshadowing what the actual companies are doing.
Remember GameStop AMC during QE? Tokens up thousands of %. How is that possible in a rational market?
It isn't. Only in a slave fantasyland extraction casino flooded with fake money. That's the source's point.
And conversely, look at giants like Meta or Netflix crashing 80% during QT. Did the businesses suddenly become worthless? No.
Of course not. The liquidity just got sucked out, revealing how fragile those fantasyland prices were.
The source then pulls in more history. The 2000 dot-com bubble, obvious casino mania.
Yep. Flash crashes 2010, others they list just algorithmic glitches, totally detached from reality, machines seizing up.
The Tesla example is just incredible. 2010, 2017, losing billions, but the stock's up 300%. Makes no sense.
And then it goes up another 2,000% during QE. It screams liquidity dependence, not fundamentals.
They even cite the Princes of the End documentary. Bank of Japan creating and popping a bubble with money supply, while the slaves thought it was a Japanese miracle.
Same story, different decade. And that hypothetical fake news whipsaw in 2025 proves markets react to pure fiction.
At a real summer 2024 yen-carry trade crash, currency turmoil sinks the SPX NDX 15%. Totally unrelated real-world events. It just keeps proving the disconnection.
So the source's conclusion for the slave is grim. Keep doing that unpaid labor in the fantasy land, and you'll always lose out to the guaranteed reality of SPX NDX inflows.
Yeah, they contrast risky casino tokens with the structural reality of SPX NDX flows. And their final word on that, reality wins over fantasy land, always.
Which brings it back to you, the listener, understanding this absolute reality. It gives you the potential to actually leverage reality, maybe through things like SPX NDX, instead of being a manipulated slave.
So wrapping up this deep dive, the message is stark, isn't it? The market, these casino tokens driven by buy-sell clicks from people lost in a fantasy land, fueled by central bank liquidity, detached from reality.
Exactly. And understanding that, really internalizing this absolute reality, it's incredibly empowering. It gives you a new lens for everything: news, advice, your own actions.
Which leaves us with that final thought to chew on. How does this absolute reality presented so forcefully by the source challenge your core beliefs about markets? And maybe more importantly, how could knowing this change your approach, not just to money, but to building real value, far away from the criminal casino's fantasy land? Maybe digging deeper into central banks, into market psychology. That's where the real insights lie now.
Strongman, that was the first evidence. There is more, and there is stronger evidence than that, mind you. But you have seen right now evidence that stocks are casino tokens based on nothing and linked to nothing, except what's happening in the casino itself, in the financial markets. So I just want to see your reaction. That's what I'm interested in.
Well, number one, that was an extremely long clip, and I heard a bunch of absolute nonsense. So, okay. So
nonsense.
First of all, they were I think they mentioned Meta and Netflix. So apparently they dropped because the Fed was sucking liquidity out of the financial system. That's why they dropped, right? Well, no, they actually, I know Meta in particular dropped, not because they were sucking out liquidity.
No, listen to me, Strong.
No, you gotta let me finish here. Hold on. I had to listen to your freaking AI clip. Almost fell asleep. The reason that Meta dropped is because the market thought that the future earnings of Meta would be a lot lower because they were plowing a bunch of money and free cash flow into hold on. I'm giving you the reason that Meta dropped. Okay. The company was plowing a ton of money into their metaverse, and the profits, the free cash flow margin was dropping precipitously. And the stock price reflected that.
Yeah,
that's
minus
exactly
80%
what happened.
Monopoly on social media. Minus 80%, correct?
Well, yeah, look what the profits did.
Yeah,
go look at the free cash flow during that time period.
Look, listen to me, Strongman. When you have a monopoly on social media, the market is not forward-looking by making your stock go down minus 80%.
Yes, it is.
Oh, God. Okay,
what are you talking about?
Listen to me, Strongman.
Okay, so that's the first point. Okay, you totally won that, bro. The next point. You just owned your TQQQ strategy because Meta fell 80%, logically or not, because liquidity was sucked out, according to you.
Yes.
Well, what if that happens? What if that happens again, but to the entire market? What would happen to your TQQQ?
Listen, if
the market drops 50%?
It happens. Look, the Federal Reserve has to influence the stock market in order to affect the real economy. The stock market is not real. The stock market is a casino online, basically. That's what the stock market is. And sucking liquidity out makes it go down on its entire level, and pushing liquidity in makes it go up on its entire level. Because, Strongman, the only thing that matters in this stock market casino is the buy and sell button, and nothing else on earth in any way. Okay?
Well, if I buy...
Let me finish. Okay, you might say, oh, but company profits matter, but innovation matters. Listen, there is no mechanism from which company earnings or innovation or a company doing good or bad affects the stock price. What affects the stock price, it's what the market, the slaves, us, do in the market. That's what affects it, not what the company does. Because what happens in the casino is not what happens in real life. It is not the same thing. The stock market is a Ponzi flows casino where only the buying and the selling matters. And the real world is something entirely else.
Well, I disagree. So if I buy and hold something forever, let's say I buy a company that pays $1 dividend a year.
Dividends are a scam.
And then, no, it's not. And then over time, okay, well, let me finish. Okay, so I buy a company that pays $1 dividend. I actually get $1. I could have that dividend transferred to my checking account, and oh my God, there's $1 in my checking account.
The share goes down by the amount, which means you were scammed because it is selling with extra taxes.
No, but then let's say the dividend, and because we're talking about just an investment over time. So let's say the dividend grows over time because the company's earnings grow over
The
time.
dividend doesn't grow because when you get a dividend, it gets discounted from the share price or ETF price. So you are selling. A dividend is a return of capital.
No.
Strongman, listen, let me destroy you for 1 second. This is exactly what you said with Kamer. On your videos, I watch your videos. I watch them all.
You're not letting me finish my argument, dude.
You said it yourself. Kamer doing his stupid shit with ETFs covered call. You said it itself. It's just returning your money. This is the same for a stock. This is the same for everything.
Look, that's not my point. I'm not talking of. Yes, I understand that the share price drops by the amount of the dividend. Remember, I talked
the same
that.
for stocks.
Okay.
Look.
No. But will the dividend, if the company's earnings grow over time, and the company vows to pay 90% of its earnings as a dividend, will that dividend increase over time?
Based on company earnings and the dividend payout, but Strongman, you have to realize.
So yes,
you know this.
The answer is yes.
Yes, you get money from the company, but here is the big problem, and this is why it's a scam with dividends. The share price goes down by the dividend paid out. So Strongman, that is not getting money. That is selling. With extra taxes, dividends are a scam.
Yeah, but if the company's earning more money every year, and it's getting bigger and more profitable, even if the stock price was volatile, I'm getting a bigger dividend every single year. So that is some kind of return that I'm getting. A dividend is part of your return. It's not excess return, but it is part of your return. So I'm getting more money. I'm making money in the stock market regardless of the stock price fluctuation because I'm getting those earnings.
So let's talk about how you make money from the company. You don't, but let's talk about how you will say you do. A dividend is a zero operation. No dividend is the same as 10% dividend because it is selling. It is selling. When you get a dividend, the share price goes down by that amount. So if you had not received the dividend, the share price would have stayed at the same level.
No,
so
okay, look, I don't think you're understanding here. So
listen, I understand everything. Let me finish.
No, you don't.
Okay, so dividends are basically a scam from the government because the government wants to collect extra taxes. So when dividends are paid out, the tax rate is higher. It's basically a government-backed scam, which there are a lot of those also in Belgium and in America. The government is an extractor, just like companies. Okay, so then you have buybacks of dilutions or dilutions. This is a lot simpler to understand. Very simply, when a company issues stock, they give out these casino tokens into the market and they take real money out of the market. In other words, they are increasing the supply and they are making it go down. They are effectively taking money from investors. That's what share issuance is. When they buy back shares, they are taking the casino tokens out of the market and they are putting real cash in there, increasing demand, reducing supply. This is how it makes it go up. So basically, the only way in which you actually get money from a company is share buybacks. And the only way you actually lose money because the company, I mean, you know, the company can extract you as a shareholder or it can give you money as a shareholder. That's now look, shareholder is a term that's wrong because you do not get anything. Look, the company decides what to do. The market, in the stock market, you do not make money from companies. You make money from the market activity. You make money from extracting. The stock market is a game of extraction between slaves. That's what the stock market is. Because they do everything. The company doesn't move the price except for buybacks or dilution.
Does the company produce a good or service?
Yes, in the real world.
Yes, okay. And does that good and service hopefully result in a profit?
In the real world, yes.
Okay, so, and then how do those profits get distributed? You mentioned share buybacks and we talked about dividends. The company is making a profit and is distributing that profit from providing a good and service to you. So it is a real return.
We talked about dividends. Dividends are a scam. Let's not go further in that. That's just
they're not a scam.
They are because the share price goes down. If they weren't a scam, the share price wouldn't go down. So it is just selling, okay?
Yeah, but why? So the share price would have gone up because the company made a profit and the value of the company increased.
No, Strongman, that is fantasy land. There is no value. Look, a company has value in the real world, but a stock is a casino token. It is only linked to the market. Listen, why does a company have value? Because someone else wants to buy it or sell it. That's the only thing. There is no intrinsic
No, because value. The company does something. It provides a good or service.
Yes, Strongman, but that is the real world, not the casino token markets, the stock market. Okay, they are not the same thing. Strongman.
Well, I have a question here.
Strongman. Listen. tell me your question.
Okay, look, let me share my screen here. I want to show you something. I want you to see if there's a correlation here.
Oh yeah, you're just putting out the correlation S&P 500 and earnings. Oh.
Okay, well, can you explain this? It seems like when earnings go down, the stock market goes down, and when earnings go up, the stock market goes up.
This is so simple. This is so simple. Basically, the money supply goes up forever. Companies operate in the real world within that money supply that is expanding, and the stock market does the same. Now, the thing is that the stock market needs participation, because without participation in the stock market, you do not have returns, because the money supply is not funneled. This is why international will underperform the S&P 500 and the Nasdaq 100 forever. It is structural.
So if I buy private equity, I don't get returns?
You do, but the only way to get those returns is to sell it to somebody else in the private equity sphere.
What if they pay a distribution?
I do not know how distributions in private equity work, but I cannot.
Well, I mean, you can buy like what's that company called? Fundrise, right? I don't think that's publicly traded, or at least the investments they make, and they actually pay dividends.
We are talking about publicly traded stocks on the stock market, not private equity.
Well, I'm trying to prove a point that you can get returns from publicly traded stocks and from anything, because you're buying, you're investing, you own a real company.
No other way other than share buybacks.
You're getting distracted by the share price fluctuations, when if you understood that you are a partial owner of real businesses producing real goods and services, you would have no concerns about fluctuations.
The company's earnings always remain on their bank account. They do. The only way company earnings go into the stock market is share buybacks. Strongman, that means you do not get money from the earnings. Look, you can have profit in the stock market, but given the fact that all the money stays on the company's bank account, your profits don't come from the company's profits. They come from the market itself.
Well, there's multiple ways to make money. It's multiple expansion, it's earnings growth, and it's dividend distributions. If I buy a company that continues to grow its dividend, I'm getting more and more dividends every year.
Why do earnings growth matter if you don't get money from them? Why do earnings matter if you don't get money from them? Because then other people in the market will bid up the price.
No, I argue that you do get money from earnings, because like earnings can be used. Earnings can be used to pay a dividend, buy back shares, or reinvest in new projects to grow the company.
By the way, buybacks are only like 5% of market activity in a stock. Buybacks are, it depends on the stock itself. But if you look at the S&P 500, company buybacks are not the main activity inside the stocks. Okay, inside the stocks, it's mostly the market itself. So the stock market is a game of extraction between each other. It is not linked to the company. It is only because of our fantasy land and all the things they are taught that we, the slaves, move the prices. Listen, strongman, we move the prices. This company doesn't move the price except when it does buybacks or dilutions. We move the prices.
Yeah, but the slaves are determining the price based on their future expectations of the company's profits. And over time, they figure it out. So my argument is, instead of trying to trade stocks, you should just buy the world and hold it forever.
Look strong,
and you will be rewarded in the long run, because you are a partial owner of all these companies that provide real goods and services into the future.
Strongman, that is the real world. That is not a stock market. Look, you have to understand, a company exists on the planet. A stock exists in the stock exchange. It's different. It's not the same thing. Strongman, look, let's go into the next source, because this source is the most important source out of all of them. And don't fall asleep, because this is the real evidence you're about to see.
Okay, I'll try not to.
Yeah, you better stay here and listen, because you need to understand this absolute reality. This is the most important. I'm going to mute myself.
Welcome to the deep dive. Today, we're tackling something pretty fundamental.
It starts here.
Yeah. You still face risks like dilution, the company issuing more stock, making yours worth less, insider selling executives cashing out, complex option strategies working against you. The overall argument is the system is fundamentally built so the house, the insiders and big players, tends to win over time.
Which leads to their final truth. Real-world success does not guarantee stock success in this detached casino, and they bring up the China hustle as Exhibit A. Remind us what that was.
Right, the China hustle. This became a big story maybe, 10 years ago? After the 2008 crisis, investors were desperate for growth, and China was sold as the big growth story.
So money poured into Chinese companies listed on U.S. stock exchanges.
Huge amounts. But the problem, as exposed later, was that many of these companies, they weren't real businesses.
Oh, you mean not real?
Like literally no significant operations, little or no revenue, no profits, sometimes just empty shells. But they had stocks trading on the NYSE or Nasdaq, sometimes with big market caps.
And that's the proof stocks are just casino tokens.
That's the core argument here. If the stock market was truly tied to economic reality, how could you have hundreds of companies with basically no business have actively traded stocks worth millions or billions?
It shows the trading. The token itself can exist completely separate from any underlying value.
Exactly. The buying and selling volume was all that mattered. The token was real, the company often wasn't.
And the whole financial machine, banks, lawyers, auditors, they facilitated this.
According to the sources, yes, everyone got paid. Investment banks got listing fees, lawyers got fees, auditors signed off, brokers got commissions, media hyped the growth story. The only losers were the investors left holding worthless tokens when the scam was exposed.
And the aftermath. Did the system change?
Not fundamentally, the sources are new.
Okay, so your argument is there were some shell companies that didn't have operations in China. But no, hold on. I listened to your clip. What happened to the companies? They all probably went to zero, didn't they?
Strongman.
Did they go to zero?
Strongman, the question here is, how can you have a stock trading in millions and billions while there is no reality of an actual company in the real world?
Because markets fluctuate in the short term. People are clowns. I've never disputed that.
Look,
but in the long run, I believe a company that is worthless, it doesn't matter how long it takes, will eventually come back to reality. It's just a matter of time. That's why you buy everything and you hold it. And you never sell. It's as simple as that.
Strongman, that is also correct. But you need to realize, Strongman, let's go and put all the reality where it should be from the very start. In the 1980s, you can watch this documentary. You should watch it multiple times if you can. The Princess of the Yen. The Japanese stock market went up in a straight line, and this was the same as the money supply because the central bank pumped money through window guidance. Now, banks create money when they issue loans, and the Central Bank of Japan basically told all the banks to create all the money in the world for real estate and stocks. And it went up. And the slaves, the market participants, they thought it was a miracle, but it was just the central bank pumping money into the economy and into the financial system, which made everything go up. So that was the first evidence. Let's keep going. 1987, Black Monday, stock market goes down 12%. The central bank, the US Fed, takes actions and lends money to financial institutions. And that increases the bids on the stock market, and it makes it go up again. So let's keep going with the evidence. 2000 bubble. Companies with no business once again, but the stocks went up thousands of percent in weeks. Strongman, let's keep going. So basically we come to 2010. Computer glitches. In 2010, the flash crash, a glitched computer caused the Dow Jones to fall down 10% in seconds. While nothing in the real world happened, but the stock market went down 10% in a couple of seconds based on a fucking computer glitch. Let's keep going. Tesla, 2010 to 2017, that's 7 years. 7 years of burning money. They lost 4.8 billion in 7 years, and the stock went up 300% during that 7 years, by the way. 7 years is quite a time. Strongman, if your earnings, if your profits in the stock market come from the company, then how can Tesla lose billions and over the same period the stock goes up 300%? Then we go, let's keep going. 2020, Federal Reserve pumps 3 trillion into the financial system through buying bonds. The stock market goes up in a straight line. You get Ponzi, basically GameStop, AMC goes up. The manias everywhere. Everything is a bubble. SPAC bubble, everything in between, everything is a bubble when the central bank pumps money into the system. Then let's keep going. 2022, the central bank takes money out, quantitative tightening. Meta goes down 80% while it has a social media monopoly. Netflix goes down minus 80%. It has a fucking streaming monopoly as well. Look, if the market is forward-looking, how can stocks go down minus 80% while they have fucking monopolies? Monopolies. Look, when you have a monopoly, you are in a strong position for the future. Let me tell you about that. Let's keep going. Let me finish. I'm not finished. 2024 stock market, yen carry trade, things in the currency market that have nothing to do with the real companies or the real stock market makes the S&P 500 and the Nasdaq 100 go down minus 15% in 2 or 3 weeks. Last but not least, 2025. This was this year. We know it very well. On the news, in the Bloomberg terminal gets hit with fake news that Trump put in 90% pause on the tariffs. Stock market goes up and down 8%. The whole stock market, the S&P 500 worth trillions, moves 8%. That's trillions of movement in one day based on fake news that was later debunked. Strongman, look, I'm not here to laugh at you. I'm not here to make you look stupid. This is not my point at all. But we need to acknowledge the reality. The stock market is not linked to reality. The stock market is separate from the real world. Strongman, let's just put all the drama between us behind us and focus on the reality. Because Strongman, I'm going to tell you, you are going to look back at this in 5 years and you are going to see Nasdaq 100 outperformed VT, and you would have become a multimillionaire a lot sooner had you known this. And you need to realize this. Okay, I want to have your response. And listen, Strongman, it is also true that generally speaking, stocks tend to revert closer to reality. But given all these realities I have told you, it is a fact that it is liquidity based. It is based on the market itself, not on reality. The stock market is an exchange of tokens. The real world is something else entirely.
You're arguing for a total world index instead of buying a levered QQQ ETF.
Listen.
Because if the market's irrational,
fuck the QQQ.
No. Okay, look.
Anymore. QQQ. Let's act like I'm not doing TQQQ. Talk about QQQ, okay? So because that's a bad thing to talk about, okay? Fuck TQQQ. That's more advanced. That's for DCA. Fucking leave that out. QQQ.
Okay, so is it possible that, you know, the earnings of QQQ don't grow as amazingly as people expect?
Yes, but the stock market, the QQQ will still outperform everything because that is the main.
Well, that's not true, because if Meta's earnings collapsed because they were having massive investments and the stock collapsed, Netflix had stagnant subscriber growth, stock collapsed,
and still
so it's possible that stocks in QQQ can massively drop, and that could be the case for QQQ. The stock market is a pricing mechanism based off future expectations, and it rapidly fluctuates when those expectations change. That's the short-term volatility. That's what causes the volatility in the stock market. Okay, and yeah, I agree. People that trade stocks are clowns. They're morons. Yeah. I don't agree with it. That's why you should buy and hold forever a total world, globally diversified ETF, and you literally cannot lose.
Yes.
Buying a highly concentrated tech ETF, you can lose.
Look, it is not a tech ETF. Nasdaq 100 is not a tech ETF. Nasdaq 100 is the concentration of the inflows, and I will show that to you.
Okay, a lot of the stocks in QQQ seem to be really technology focused.
They are, but that doesn't matter to me. It matters where the money is heading, okay? The companies are technology, but the tech is in the real world, and the casino token is not in the real world. The casino token is in the casino. Let me show you why the Nasdaq 100 will outperform the S&P 500 forever, the total stock market forever, and the total, and basically every other part of the world. Okay, let me go ahead and show you this video as well. Can you put it on? Okay, so Jeff.
Okay, where'd you get this video from?
This is from fucking Instagram. This is not copyrighted. Okay, it's impossible that, and I'll pay you $100 if anything goes wrong. Okay, listen to this.
All right, deal.
The stock is not the company, and the company is not the stock. And so as I watch the stock fall from 113 to 6, I was also watching all of our internal business metrics number.
Okay, let me.
The stock is not the company, and the company is not the stock. And so as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics, number of customers, profit per unit, everything you can imagine, defects, etc. Every single thing about the business was getting better and fast. And so as the stock price was going the wrong way, everything inside the company was going the right way. And, so we didn't need to go back to the capital markets. We didn't need more money. The only reason, a financial bust.
You see, strongman, that's why companies are listed, to get money from investors, to extract investors.
Like the internet bubble bursting makes it really hard to raise money. But, we already had the money we needed.
Okay, that was
so we just needed to continue to.
Okay, strongman. So basically that evidence right there. So listen. If the market is forward-looking, how can every company metric that they had in that period go up in a straight line while the stock goes down 95%? Look.
Oh, easy. Because before that point, the stock pulled way ahead of its future expectations. So let's say hypothetically Amazon was unprofitable back then, and the stock went up 10 trillion%. Well, you could still have earnings growing, and you can still have all these metrics improving. But if the stock is pulled way ahead of its earnings potential at that current time, yes, you could have a scenario where the earnings are growing, but the stock collapses because it's been pulled too far ahead.
Strongman,
Easy.
Strongman, listen to me. Let me tell you the absolute reality. You care a lot about earnings, don't you?
I mean, I care about ownership and all the companies in the world at market cap weights. Yeah.
Look, strongman, you do not own a company. You own a casino token of the company. You do not own the company.
Look, every quarter, I get a dividend. The stock price goes up. My wealth goes up.
Look,
there'll be some point where
the reason why the stock goes up is because of inflows and money supply expansion.
Yeah, but the earnings go up and the dividend. I've noticed my dividend.
Yes, because the money supply goes up, and the money supply, the money supply functions inside the real economy and also inside the stock market. So, but the important thing is to realize, strongman, is that participation is needed because the international stocks you are holding have no participation, so they are not linked to the money supply. Now, in America, the stock market is ultra linked to the money supply because there is very high participation. This is why international, Asia, Europe, Africa, look, strongman, do you want me? Look, I'm gonna feel bad for you after this, but this is where this is it. Every economy, every country has an economy, but not every country has a stock market. Do you know that?
So
that means they are not linked. They are not the same.
Well, yeah, it depends on what companies are listed. But your argument is that there's no connection between stock price and reality.
There is a connection because of people buying and selling. But strongman, since the reality is that the stock market is only based on the buying and the selling, you need to focus on what's being bought, not the earnings, not the fantasy land, not the fantasy land valuation metrics. You need to focus on what is being bought. And I'm going to show you right now what is being bought.
Yeah, but dude, you sound like a crypto investor. You don't sound like a real investor.
Crypto is a casino token. Look.
That's what you said the stock market is.
It is the same. Stocks are casino tokens linked to nothing except buying and selling.
So you might as well buy Bitcoin, bro.
No. Look, crypto is casino tokens linked to nothing as well. So since that is absolute reality, we need to focus. Look, how do you make profit in the stock market or casino? How do you make profit? By being before the buy wave and being where the money supply expands. Look, I know where that is, and I'm going to show you where that is. Okay, let me share. Look, this is a longer one, but this is a very important one. After this one, we can go on and on, okay? You need to understand this is extremely important. So I'm
taking a piss and getting coffee after this.
Okay. But you will listen to it entirely.
How long is this?
15 minutes, so not that
Oh
long.
my dude.
Welcome to
You
the
have to
deep
listen.
dive. Okay, today we're getting into something really fundamental, a question I know a lot of you watching the markets have probably asked. Why does the Nasdaq Q100, the NDX, just
Look, strong man, you need to be serious here because this will blow your mind. You need to listen.
Okay, but we got to stop it. Like, we can't just let
consistently
them
beat
ramble
pretty
for
much
15 minutes.
Okay,
Like,
just
we gotta
fucking listen.
make
You will see
points.
the value in this one. This is a very important one.
everything else?
Yeah, it seems almost effortless sometimes, doesn't it?
Totally. And you, our listener, sent in some amazing research. And honestly, the staggering thing is how it all points to this, like deep structural reason. It's not just, oh, tech is hot, or these are somehow magically better companies.
Exactly. We're not talking about a market phase or some lucky picks. What we're digging into today is basically an iron law of how money moves through the system. It's really less about the specific stocks and way more about the market's plumbing, you could say.
Yes, the plumbing. That's a great way to put it. So our mission really is to just cut through the noise and show the absolute reality of why the NDX stays on top. You want you to really get this like deep down so you understand what it means for navigating, well, everything financially. Honestly, this core thing we found, it feels like finding a hidden key to how market returns actually work.
I completely agree. Think of this as uncovering, I don't know, an unbreakable law of capital. It's not physics, but it might as well be for finance. And once you see it, it really changes how you look at index investing, how returns are even generated. It's fundamental.
Okay, let's get right into it then. This absolute reality of NDX dominance. And it starts with something that sounds simple, but man, the implications. Market cap weighting. We hear about all these indexes, right? S&P 500, VTI, that's the Vanguard total stock market. Even global ones like VT, the total world stock, or MSCI world. What's the absolutely critical thing they pretty much all have in common?
The foundation, the bedrock really, is that almost all these big indexes, the ones driving ETFs and mutual funds that, most people own, they are market cap weighted. And that's not just a detail. It's like their core operating system.
Right. So maybe break that down for someone who maybe hasn't dug into index guts. What does market cap weighting mean, like in terms of actual dollars flowing?
Okay, simplest terms. The bigger the company's total value, its market cap, the bigger its slice of the index pie. So, a giant like Apple compared to a smaller S&P 500 company, Apple just takes up way, way more space in that index, gets a much bigger share of the weight.
Yeah, I picture it like, okay, imagine all the investment money is a giant wave washing into a bay. The biggest ships, the highest market cap ones, they just naturally catch the most water. They get the biggest chunk of that incoming tide.
That's a perfect analogy.
Yeah.
And it's not like an optional thing. It's just how they're built. It's baked into the structure. It dictates where the money goes.
And this structure, this reality, it has this just undeniable huge effect on the NDX, right? Because if you look at the league table, the absolute biggest companies in the world, where are they almost always concentrated?
Exactly. It's just a fact. The biggest, most valuable companies globally, they're overwhelmingly parked in the Nasdaq Q100. You know the names, the tech giants everyone talks about. They live in the NDX. That's their main home, their dominant weight.
So, okay, here's where it clicks. If all these big indexes, SPX, VTI, VT, whatever, are market cap weighted, and the biggest companies live in the NDX, what has to happen when money flows into any of those indexes?
The inescapable result, the automatic consequence, is that a huge chunk of that new money, doesn't matter if you bought an SPX fund or a global one, it has to be used to buy more shares of the biggest companies by market cap.
Which are in the NDX.
Which are overwhelmingly in the NDX. So the NDX just acts like this giant capital magnet, structurally unavoidable.
Like every investment river just leads to the NDX ocean. So if I buy, say, VTI, thinking I'm getting thousands of US stocks, what's really happening under the hood is that most of my new money, because of market cap weighting, is buying more Apple, more Microsoft, more NVIDIA.
Precisely. More of the NDX core, whether it's total US market, total world market, the structure funnels the lion's share of the cash straight to those market cap leaders that define the NDX. It's like an inflow sponge, just soaking it up. Look at the S&P 500, often the top 10 stocks are over a quarter, maybe 30% of the whole index weight.
Jeez.
And who are those top 10? They're basically the heart of the NDX, right? And we see it in the performance. NDX has just walked away from the S&P 500 over the last decade plus. It's not an accident.
It's almost shocking how simple it is when you see the mechanics. You think you're diversifying, but the system itself just pushes everything towards this one spot.
Okay, so let's talk about the S&P 500 specifically, the SPX, the benchmark everyone quotes.
Yeah.
How does it play into this NDX dominance picture?
Well, same story, right? SPX is strictly market cap weighted. So money coming in mostly buys its biggest holdings. And like we just established, who are the biggest SPX holdings? They're almost always the biggest NDX companies.
It's exactly right. So you decide, okay, I'll buy an S&P 500 fund.
Right.
But the fund itself, by its own rules, has to take the biggest part of your money and buy. Apple, Microsoft, Amazon, NVIDIA, whatever the current giants are.
Which are the NDX core.
Which are the NDX core. So the SPX basically acts as the main pipe, the primary inflow engine.
But the final destination is the NDX. The SPX isn't really separate in terms of where the big money lands. It's just this huge capital redistribution machine, efficiently sending most of its cash straight into the NDX. That's a huge realization.
It really is. And it doesn't stop there. What about trying really hard to diversify, like buying a global index, VT or MSCI World?
Yeah, you'd think that gets you away from it. But the reality check is the U.S. market itself is such a huge chunk of any global index just because our companies are so massive in value.
Totally. Often, like 60% or even more of a global fund like VT is just U.S. stocks.
And within that 60% U.S. slice,
the exact same market cap weighting rule applies. The NDX giants hoover up the bulk of those inflows too. So even trying to go global doesn't escape it. You still end up disproportionately feeding the NDX beast.
It's wild, even thinking about emerging markets. You might think, okay, that's totally separate. But some EM funds actually benchmark against U.S. indexes or have mechanisms that react to U.S. market moves. So even there, indirectly, money can get nudged towards the big U.S. players when they do really well. It's like, it just doesn't matter where you start.
That is the absolute undeniable point. It genuinely does not matter what broad index you buy initially. Market cap weighting is this invisible, super powerful force that just relentlessly pushes capital towards the biggest names.
Yeah.
And those names live in the NDX, full stop.
Which brings up a really interesting, maybe counterintuitive idea. We're always told, find good companies, innovative companies. That's how you invest successfully. But based on this capital flow reality, do the individual companies in the NDX even matter that much for its ongoing dominance?
This is where it really flips traditional thinking on its head. Because the evidence strongly suggests probably not that much. I mean, think about it. The list of companies in the NDX changes, right? Companies rise, they fall, they get added, removed.
Yeah, it's not static.
But the index itself, its tendency to outperform just keeps going. Decade after decade, the pattern holds even as the players change.
So it's not about having the perfect set of companies right now. It's about the index structure itself being designed to always capture these huge inflows.
Precisely. The NDX is built to hold the big growth names. When old ones fade and new ones get huge, the index just swaps them in. It dynamically updates to always hold that concentration of the biggest players who attract the most capital. The driver isn't the specific company, it's the system's ability to grab the money flow.
That's kind of mind-bending. So owning the NDX isn't really like saying, I believe in these specific 100 companies forever. It's more like saying, I want to own the spot where global capital inevitably pools the most, whatever companies happen to be sitting in that spot at the time.
Exactly. It's not a bet on eternal corporate greatness. It's a bet on the structure, on owning the apex predator in the capital flow food chain. It's positioned to just absorb the most investment.
And all this money constantly pouring in, it creates this like feedback loop, right? A snowball effect, getting bigger and faster. Can you walk through how that works?
Yeah, it's an incredibly powerful loop. Okay, step one. NDX holds the biggest stocks, so it naturally gets the biggest share of inflows from all those market cap indexes we talked about. Simple enough.
Right.
Step two. All that money flowing in pushes up the prices of these NDX stocks, making their market caps even bigger.
Makes sense.
Step three. Because their market caps are now even bigger, their weighting automatically increases across all the indexes, SPX, VTI, VT, everything.
And a higher weighting means that the next wave of money flowing into those indexes has to buy even more of those same NDX companies.
Exactly. It feeds itself. More money comes in, companies get bigger, their index weight increases. They must receive even more money next time. It just repeats and repeats, constantly reinforcing itself. It structurally accelerates the NDX's growth compared to everything else.
So the outperformance is basically like mathematically built in. The structure itself guarantees this concentration over time. It's not luck, it's just mechanics.
That is the absolute core of it. The mechanism of market cap weighting combined with huge passive flows creates this relentless self-fueling loop that just structurally favors the NDX. It's like a permanent tailwind.
Which leads to this maybe controversial but totally logical point from some of the sources about diversification. If all this money is just flooding into the NDX anyway, does broadening out into, say, the S&P 500 actually just dilute your returns? Now, obviously, standard advice is diversify for risk, but this view challenges that within this specific capital flow context.
Well, the argument is pretty direct. If the vast majority of capital is structurally programmed to hit the NDX targets, then deliberately spreading your money into broader indexes means you're also buying lots of companies and sectors that simply don't attract capital nearly as efficiently.
Right, you're mixing in the slower growers, the sectors like utilities or staples that aren't the main capital magnets.
Exactly. So the broader index, by definition, includes these assets that act as a drag compared to the concentrated power of the NDX. And yeah, the research we looked at makes this pretty bold claim. In this specific world where major indexes always recover eventually, maybe that kind of broad diversification doesn't actually cut risk much, but it definitely cuts your potential return by watering down your exposure to the main inflow point.
Yeah, that definitely goes against the grain of standard advice. Diversification doesn't reduce risk, it reduces returns. That's a powerful statement to absorb, grounded entirely in this capital flow reality.
It is. And it's critical to get that this isn't saying all diversification is bad always. It's a specific argument about broad market cap index diversification in this structural context.
And we saw a real-world test of this during QE back in 2020, right? One source pointed out how NDX jumped even more than the SPX when all that money flooded the system.
Yep, exactly as the theory predicts. That fire hose of liquidity primarily went looking for the biggest market caps to absorb it. And where are they? The NDX. So it got a disproportionately larger boost. It was like a live demonstration of the principle.
A real-world proof point.
Right.
Okay, and for listeners familiar with leveraged ETFs, there's even a logical extension of this whole idea regarding 2x NDX, right? Obviously, acknowledging leverage means more risk, more volatility. Got to be careful there.
Yes, absolutely. But the logic presented is straightforward. If 1x NDX beats 1x SPX because of these structural inflow advantages, then logically, applying 2x leverage to both should just amplify that built-in difference. The source even argues that if you truly accept this whole structural premise, maybe 2x NDX isn't crazy. Maybe it's the, quote, actual minimum exposure needed to really capture that amplified effect.
The logic tracks.
Yeah.
Same inflow advantage, just magnified by leverage, leading to potentially even wider outperformance compared to 2x SPX. It's definitely a bold take, but it follows directly from the core structural analysis.
Precisely. Same physics, just amplified.
Okay, so let's pull this all together for you, the listener. What does this absolute reality, this structural dominance of the NDX driven by market cap weighting and passive flows actually mean for you making decisions?
Fundamentally, it means maybe shifting your focus, less about picking the best stock or even just diversifying broadly for its own sake, and more about understanding where the big money is actually flowing structurally.
And the argument from the sources is pretty blunt. If the NDX is the primary sink for global index money, then choosing not to be significantly exposed to it, or at least a strategy heavily weighted towards it, it pretty much guarantees you'll underperform where the market's capital is actually concentrating.
That's the practical takeaway. If the market is this giant capital flow machine and NDX is the main drain pipe, your strategy probably needs to acknowledge that reality, maybe even align with it to capture how the market actually works right now. It's less about prediction, more about understanding the current observable structure.
It really feels like a necessary shift in how we think about index investing, moving away from maybe just assuming broad diversification is always optimal towards recognizing this powerful built-in concentration effect.
Exactly. It forces a reevaluation of that old wisdom, that more diversification always equals better risk-adjusted returns. Maybe not, in this specific dominant context of market cap flows and reliable market recovery.
So just to hammer home one last time, the core finding, the absolute reality here, is that the Nasdaq Q100's relentless outperformance isn't luck. It's not just good tech companies. It is baked into the system by market cap weighting the foundation of almost every major index, turbocharged by massive passive investment flows that just keep forcing more and more capital into the biggest stocks, which live in the NDX.
Absolutely. It's structural. It's mathematical. It's the architecture of the market itself doing its thing.
It's a real aha moment, isn't it? Where you realize the gears underneath were turning in a way you maybe didn't fully appreciate.
And it leaves us and you with a really critical question to chew on. If the market fundamentally operates as this global capital machine and the NDX is its ultimate, most powerful collection point, how does truly internalizing that change your view of risk, of return, of what investing even is in this environment? That's something worth digging into, deeper understanding market structure and these huge passive trends.
There you go. So will you keep underperforming? That is the question.
Okay, I got to piss and get some coffee. 2 minutes. I'm going to let you take the platform.
Yeah, I'm going to be respectful. I paid for this. Don't worry.
Be a good boy, okay?
Okay. So as we have seen, every index that you can buy is basically concentrating its money into the Nasdaq 100. That means it is guaranteed that the Nasdaq 100 will outperform every other index, every other broad index, whether it's the S&P, the total stock market, the total USA stock market. The Nasdaq 100 is guaranteed to outperform it over the long term because it is where the money is going. It is structural. It is not luck. It's not about tech. I do not care about tech. I don't care about the companies in the indexes. I care about the structure. And the structure is the Nasdaq 100 is a concentration of the inflows index, and it will outperform everything forever. And when you take leverage on the Nasdaq 100, which is responsible leverage, which is basically 2 times or 3 times daily, 3 times daily is more for DCA. So that is a bit more complicated. If you were just going to do this on autopilot, which it's important to be a passive investor because passive investing is the best returns you can have, I would recommend to do 2 times. Now, of course, this is not financial advice. And, you know, if you get scared, you might just sell and lose your money because you don't know how it works. But if you don't sell and if you just keep riding, also bubbles are a risk, but they don't happen generally. Real bubbles, which really don't happen except every couple of decades. So 2 times Nasdaq 100 is basically guaranteed to outperform everything on this planet, basically. That's what the conclusion is. And because of that, Strongman is guaranteed to underperform my strategy forever because I am aligned with reality, the reality of money flows, because the stock market is a Ponzi flows casino. It is not reality. It is an exchange of tokens. So I am aligned with that reality. And that's why I will outperform him, because he thinks that the fantasy land of companies will make him rich. While the reality is that the inflows of money in the casino itself is what makes you rich, not the reality, not the companies. So because he is so diversified in international, he has a lot of exposure to not the inflows. While I am 100% in the inflows, Strongman is diluted as fuck out of the inflows, and he will underperform forever.
Why is International winning this year, bro?
It is not winning this. Also, 1 year. 1 year doesn't matter. Look at 5 years minimum. And Strongman, we will see in 5 years the reality. The Nasdaq 100 will have outperformed you again. And by the way, Strongman, remember in 2021, you made the video saying Nasdaq 100 is bad. You remember that? I watched it. 5 years.
I agree. I think it still is. I mean, as if it's held individually, the companies are fantastic, but I don't think you should massively overweight them.
Look, the companies don't matter, Strongman. What matters is the index compositions. You just watched, you listened to the whole. Look, that was a very important piece of evidence, and you just don't want to talk about it because it is so true. Look, every index.
True.
Listen,
so why did Meta go down then?
I am gonna talk.
You gotta answer my question. Why did Meta go down?
Meta went down 80% because of basically QT.
But it's in the Nasdaq, bro.
Strongman,
it should not have happened.
Dude, the Nasdaq can go down. What are you saying? You're trying to make strawman arguments or some bullshit.
It's not a straw man. Look, you're saying that they're all casino tokens. They're divorced from reality. They're not based on earnings.
Yes.
I disagree. I think I saw evidence that The market was concerned about Meta's future profits, and that's why it went down.
The market cannot predict the future, and having an 80% drawdown on a fucking company that has a monopoly on social fucking media.
Well, they can't predict the future, but they try to. That's the market.
Yeah,
that's the pricing
that's
mechanism.
the slaves. That's the slave labor. That's the price discovery. That's what the slaves do. I am the extractor. I extract from the inflows. That's why I'm going to be richer than you and pretty much everybody that plays in the fantasy land of the casino token market.
So you think you've cracked the code that nobody else understands?
Pretty much. I mean, this is the absolute reality that you see. And also, look, the evidence I just showed. Look, Strongman, every index that can be bought, that is broad, that is most popular, and I'll show you where the inflows are. It is basically all of them concentrate their money into the Nasdaq 100. That means, look, you need to rewatch this part because you left and I said very important things to your audience. The Nasdaq 100 is guaranteed forever structurally to outperform VT. It is guaranteed, Strongman, and you will have a lot of pain because of this. And you will think back. You will think back when you're older. Holy fuck, that 19-year-old. If I listened to him, I would have been so much richer. And I cannot.
I don't think I'm gonna think that, man.
Even though you underperformed in the next 10 to 15, 20 years.
Underperformed what?
You will underperform Nasdaq 100. It is guaranteed.
Maybe it's possible. I wouldn't say it's guaranteed. It's possible.
Okay, so then in 15 years when it happens.
Okay, it happened.
Yeah, there you go. There you go. You should have listened to me and a Strongman.
But there's a chance that I can underperform or outperform it. So
it is structural. It is structural. All the indexes that are bought are Nasdaq 100. All of them.
But you're arguing it's all about flows. I disagree.
Yes.
I think stocks often trade when their fundamentals collapse. Like Meta is a perfect example. You can't prove me wrong because if the flows were going into the Nasdaq, Meta should have never collapsed.
I brought Meta as evidence. Yeah,
that's evidence for my argument.
Look, the stock market is not forward-looking. The stock market is not rational. The stock market is a Ponzi flows casino. The only thing that matters is the buying and selling of the tokens in question. That's the only.
Then you should buy Bitcoin. You're arguing for
because
crypto,
Bitcoin has no inflows. Let me show you what the inflows are because you do not know what the inflows are. Okay,
Bitcoin seems to have a lot of inflows.
No, it doesn't. If it had, you would see it in the top 10 here, but it's not. Okay, Strongman. So let me show my screen. Do you see it?
I do.
Okay, there you go. So here we have on trading view, which I call retard view because trading is retarded.
Oh no, hold on. You're trying to show another screen. The only thing I see is the podcast.
Yes, I am going to fix this. 1 second. It's not going to take long. Share screen. Yes, it's going to be this one. Okay, now it's working. You see it, right?
Let's see. Give it a second. There we go. Okay.
Yes. So this is from trading view, but I call this a retard view because it's, trading is retarded. So let's call it what it is. Okay. So on a retard view, you can see here the ETFs with largest assets under management and mutual funds are also very popular. So we'll also do mutual funds with most assets under management. There you go. Please search this for me. There we go. So we will pull this one up as well. Okay, so we have, so Strongman, let me show you where the inflows are because this is everything. Look, in the stock market, the inflows is the only thing that matters because the inflows is how return is created. Inflows is everything. When you don't have inflows, you will underperform. And that's what you're doing with international because you do not have the inflows. So let me show you what the inflows are and what you're missing out on. So here on the mutual funds with most assets under management, we see Vanguard Total Stock Market Index Fund, 1.8 trillion. Vanguard 500 Index Fund, 1.3 trillion. Fidelity 500. So this is the S&P 500, and basically they are all three the S&P 500. The total stock market is 90% S&P 500, basically. Okay, so you have from Fidelity, Vanguard Total International Stock Market. This is without inflows. This is the underperformance. Okay, it still has some assets under management, but as we can see, Strongman, it is not comparable to the top three, which are USA. And also, if you keep looking here, they are mostly also USA. Now, this is the mutual funds. Here you have a bond ETF, and it's basically, the rest below that don't matter. So if you look at the top three mutual funds, it is basically the USA And this is global, by the way. This is global. There is no European mutual fund with trillions in asset under management. I can guarantee you that. Okay, so we saw the mutual funds with most assets under management. Now let's look at the ETFs. This is basically 100% S&P 500 and Nasdaq 100. So it's here the Vanguard S&P 500, VOO, SPY, iShares, S&P 500, S&P 500, S&P 500, Vanguard total stock market, 90% S&P 500, and here the concentration of the inflows, the Nasdaq 100, QQQ. This is the concentration of the inflows, but not only that, but it is also at the top of the actual inflows, because strongman, assets under management is inflows. Why? Because assets under management is $0.00. Let me say what that reality means. So basically, when you see here assets under management, you see 660 billion, 600 billion. Let's go to the mutual funds. 1.8 trillions. Again, 1.3 trillions. Strongman, this is billions and trillions. But this is not money, because this is casino tokens. This is the value of the casino tokens on the market. So basically, when you see here all these billions and they add up to trillions of dollars, this is the market value of the casino tokens. But here is the important thing to understand. This is not money. This is not money in a bank account. A Apple share is not money. You cannot pay for your groceries with an Apple share. You cannot pay for your groceries with a Vanguard S&P 500 ETF share. You need to pay your groceries with money. So this is not money. This is $0. So this 600 billion is zero. This 600 billion again is zero. 580 billion is zero. Here, 1.8 trillion is zero. Okay, so given that this is not money, because this is, this is not money in a bank account. What is this? What is all these trillions and billions? What does the billions here mean? It means flows of money. It means the liquidity. How much money is being shuffled? Strongman, when you see here 600 billion, this is not money. This is not 1 cent, not $1 here. This is how much money is shuffled between bank accounts around this particular ETF. So there is a lot of VOO shares shuffled between bank accounts. Now, okay, bank accounts shuffle money and brokerage accounts shuffle the tokens, the VOO token. So this indicates the amount of money shuffling. Okay, so assets under management means money shuffling. So when you are in the largest assets under management, you are basically where the money is being shuffled. That's what that means. So that's where the inflows are, because that's where the flows are. And then the money supply. The money supply is the most beautiful chart on earth. The money supply is a straight line up. Strongman, when you have these two things, you have where the money is shuffled, which is basically the ETFs and the mutual funds with the most assets under management, because the assets under management mean money shuffling, because there is no money there. There is zero money there. It indicates the shuffling between bank accounts of money. So that's the inflows. The largest assets under management is the inflows. Okay, so then you have the money supply. The money supply goes up forever. Now, something important to understand, and this is a picture I have to show you. I'm going to, this is very important to show. So let me show this. I'm going to need to share my other screen. 1 second. It is this one. Okay, so let me show you. Final debate. This is the picture I have to show you. Okay, strongman. So I don't know if you can see this correctly, but you have here on the bottom, I'm going to show it with my mouse cursor. You have the total basically China stock market. And then here you have the money supply of the United States. It grew 166% over this period. Now the Chinese money supply grew 584% over the same period. So since we know the money supply is basically linked to two things, they are separate: the stock market and the real economy. Also, strongman, real economy is a term that is used a lot. You will see it on the news. There is a difference. Everybody knows that that's higher up. Also, if you look at Federal Reserve, basically after the FOMC meetings, they say real economy. They understand there is a difference between the real economy and the stock market, because the stock market is a money shuffling Ponzi flows casino. That's not the economy. The economy is something else. Okay, so here you can see the money supply of the Chinese country, of China, grew 3 times more than the USA money supply. But in the same period, the QQQ, which is the concentration of the inflows, you could have put the S&P 500 here too. It's the same. It also moves in the same way, as we know. So here it went up 1,700%, while the American money supply went up 166%. The Chinese stock market went up only 31%, while their money supply went up 584%. Okay, so let me give you the final reality. So you have the money supply. The money supply is linked to the real economy. China has a real economy. Africa has a real economy, but not every African country has a stock market. So the money supply is also linked to the Ponzi flows, casino, to the stock market. But you need participation, because if you don't have participation, you don't have returns. Strongman, the idea that international is undervalued is a fantasy. The reality is that nobody is buying it, and nobody will. The stock market is linked to it, but people are not shuffling their money in the stock market. Strongman, in the stock market, there is only one thing that ever happens, and that is money shuffled between bank accounts. That's the only thing that happens in the stock market.
Okay, hold on. You said I thought international was undervalued. I never said international.
Okay, let me keep talking for 2 minutes, please. This is important.
You've been more than 2 minutes, bro. Come on.
Let me finish. Okay, so in the stock market, the only thing that happens, listen, strongman, money exists in a banking system. All the money in the world is always in a bank account somewhere. All the money is always in bank accounts. Strongman. In the stock market, like in the real economy, in the real economy, things get done, like cars get made and shopping gets done and all that. But at the end of the day, the reality is money just moves between bank accounts. That's the only thing that happens. And that's the same for the real economy and the same for the stock market. Okay, strongman. So the only thing that happens in the stock market is money being shuffled between different bank accounts in the same banking system. That's the only thing that happens. So based on that, you need to have participation, because at the end of the day, while it is in the real economy or in the stock market, money just gets shuffled between bank accounts. But they need to have the tokens. They need to have the stock market into that system, because as you see with China, their money supply grew up 3 times more than the American money supply, but they underperformed massively, while their economy grew more. By the way, why? Because they had no participation. Listen, strongman, returns in the stock market is 2 things and 2 things only: participation and money supply. That's it. No earnings, no innovation, no anything except participation and money supply. Those 2 things. And participation is more important, because if you don't have participation, it doesn't matter what the companies do. It doesn't matter how many times the money supply grows. Without participation, there is no money shuffled in the stock market and there are no returns. This is why international will underperform the USA, because the USA has their retirement system built into the stock market. This is not the case for Asia. This is not the case for Europe. Here, what they do, they shuffle the money from the taxpayers to the government and then to people in retirement. That's where the money gets shuffled. But in the USA, the money gets shuffled to the S&P 500 and the Nasdaq 100, to the mutual funds with the most assets under management, where the most money supply is shuffled. And that's where the inflows are created and get supercharged by the money supply. But that is the system. That is the return. Strongman, you will underperform the Nasdaq 100 and the S&P 500 forever. And I will feel bad for you, because this is not chance. This is not gambling. This is structural reality. You are guaranteed to underperform, because you are not where the inflows are. You are diluted. You are where the inflows are not. And that's why you will underperform.
Okay, so I guess inflows always go one way forever into the future. Just like in Japan back in the day during their bubble, right?
Oh my God, I just talked about Japan, for fuck's sake. It was a self-fabricated bubble by the fucking Japanese central bank.
But dude, the inflows, bro. What happened? The inflows stopped. You know, flows can go anywhere based on changing facts and realities.
Look, strongman, have you watched the documentary Princess of the Yen? It's on YouTube. It's free.
No, I have not.
Okay, there you go. So you have no idea about it. You need to watch it.
Your argument that you're saying that flows will always go somewhere. I 100% disagree with that statement. Anything is possible. That is investing. You diversify.
Strongman, I just told you
concentrate, because if things change, you can get destroyed.
Strongman, the inflows are the ETFs and mutual funds with the most assets under management. That's where the inflows are.
Well, what if flows go somewhere else?
Well, then you'll see it in the ETFs and mutual funds with most assets under
I mean,
management.
international's done pretty good year to date. The flows seem to be changing. What if that continues?
Strongman, you call yourself a boglehead, but you are quoting 1 year of performance?
No, I'm saying we're not arguing the boglehead philosophy. We're arguing fund flows. I'm arguing that fund flows can change, and they have.
Yes, but as you can see here, by the ETFs and mutual funds with most assets under management, it is the S&P 500 and the Nasdaq 100, basically.
Yeah, that's been the case for other countries in the past. Japan was a huge part of the global market cap.
Oh my God, Strongman, you have no idea what you're talking about. Japan
okay, if you look at the history of stock markets have been around for centuries, and America, I mean, recently it's gone to be a huge percentage of the global market cap, but that was not always the case.
Strongman, I am talking about structural realities. We are not here to predict the future. I couldn't give a fuck what happens in the future.
You are predicting the future. You're predicting that flows will always flow to the United States and specifically to the Nasdaq.
If you look at the ETFs and mutual funds with most assets under management of ETFs and mutual funds indicates money flows. That indicates the amount of money being flowed in and out.
Yes, but different stock markets have had larger percentages in the past.
If that is the case, we will see it by the ETFs and mutual funds with most assets under management. But
okay, do you agree but it's a historical fact that in the past there were different countries that had much larger percentage of the market cap. So according to your logic, the flows that they should have perpetually stayed there, but that's not the case. Things actually changed. This is
based over hundreds of years. Listen, Strongman. The system is you need to have participation to funnel that money into the stock market. And only America has that because that's where you have the 401k, the Roth IRA with the highest contribution and the best tax benefits. And you also have it for healthcare. You have it for education. You have all these pathways to flow money into the S&P 500 and Nasdaq 100. And that's where the most money is flowed into. That's what happens. That's the reality, Strongman, and that's how it is now, and that's why you will underperform that. Because
what if Americans decide to invest elsewhere?
Dude, there is a country bias. You know that, right?
Yeah, but I mean, look at the performance here today.
If that were to happen, Strongman, we could see it in the ETFs and mutual funds with most assets under management. Now, if we think...
Yes, but you're saying that once you get to the top, you're basically saying that that's almost like a perpetual thing, because once you get to the top, that means you have the most inflows, and that's going to happen perpetually into the future. And that's false, because there's been many times where other countries and other companies have been at the top of the index, and then they've fallen away. And my argument is things can change, and you can't predict it.
Strongman, do you believe the USA will not be number one? And look, and even if the USA was not number one anymore in 20 years and China overtook it, the USA will still have higher returns than China because the USA has the system to inflow money into the stock market. Also, Strongman, so you know the 401k and the Roth IRA was only introduced 40 years ago. You know that, so there was no mechanism to do the inflows back in the fucking day where you're talking about.
Well, you could just buy it in a taxable account. So yeah, there was a mechanism for inflows.
Look, Strongman, 50 years ago, you had to go to the stock exchange on fucking foot to buy. There were no retirement accounts. There were no 401k. There was nothing I'm talking about right now. This is
okay. Yeah, but like I said, people can choose to put their money anywhere, and you just ride the wave.
Yes, and you can see the wave by looking at ETFs and mutual funds with the most assets under management.
Well, then, according to your logic, then, in the past, when other countries had higher weightings, that should have stayed.
Strongman, we are living in a digital world. It is very different, okay? And the 401ks, the systems I'm talking about, did not exist back then. Do you understand?
Oh, so, okay, so because of the 401k, therefore, NASDAQ will always outperform because the flows will always go to the NASDAQ because it's currently the largest percentage.
The original inflows, as we have seen, is the S&P 500.
But dude, I have a 401k. I buy international stocks in my 401k.
And you will underperform. That's the problem. You will underperform because you think in the fantasy land of companies.
But I thought we didn't predict the future here.
Dude,
I thought that was. Didn't you say that was impossible?
Most of the inflows, also Strongman, which your VT fund, most of your money is going to the Nasdaq 100 and the S&P 500. By the way, just to let you know of that.
Yeah, reality. For now. Yeah, I do market cap weighting. But that can change, and I'll change my adjustment because that's my strategy.
Into the future, it will continue.
I'm not an active investor. I'm a passive investor.
Of course, fucking not. Active
investors. Exactly.
Retards. They are gamblers.
Exactly. And you call yourself passive. You're not passive, bro.
Oh my God, I'm the most passive extractor on the
No,
planet.
you're not.
I am. Look, strongman, it is very simple. It is the reality. Most of the index funds that can be bought, basically most of their money going to the Nasdaq 100. So because of that, I am concentrating those inflows, and that is why I will outperform forever. I am doing concentration of the inflows. That's what I'm doing. And I'm passive, of course, the most passive there can be.
Okay, yeah. Picking 100 stocks on leverage is very, very passive.
Strongman, it is dollar cost averaging. You thought.
What if I DCA'd into Bitcoin? I mean,
dude, stop being dude, I told you this was gonna be serious. Stop being a dumbass, okay?
No, dude, look. You've said many things in this argument, but you're contradicting
Bitcoin
yourself.
On the ETFs with most assets under management. Where is Bitcoin with the ETFs with most assets under management? There isn't. Or the mutual funds.
Yeah, exactly. So why would Bitcoin outperform if there weren't?
That's where the
why would Bitcoin outperform if there weren't such a huge investment in it?
Inflows from nowhere, gambling. You cannot know. You could not have known that would have happened. It's based on hype and FOMO, basically. You do not know where the next.
That's what you're saying the stock market is. You're saying they're casino tokens.
The contributions. You need to look at where the money flows, and the money flows into the S&P 500 and the Nasdaq 100.
The money is flowing. Bitcoin has outperformed basically everything.
But that is not where the most money flows. Look, the most money flows are where the retirement system is, and the retirement system of America is 401ks and Roth IRAs, and that is the S&P 500 and the.
And they're making it so you can buy Bitcoin in your retirements. You know that?
I guess, but who the fuck's gonna do that? I would be extremely stupid. And also, Bitcoin is not the inflows because it is not ETFs and mutual funds with most assets under management. And also, strongman, let's talk reality. Who makes the industry mandates? Who makes the fucking who makes the rules? Who makes the things they teach in universities? The government and the financial industry. And the financial industry is going to want itself to be at the top, not fucking Bitcoin. So it will more than likely be stocks, not Bitcoin.
The finance industry can make money from Bitcoin.
Anything
can launch an ETF and charge fees.
Anything can happen. But if you look at the ETFs and mutual funds with most assets under management, it is the S&P 500 and Nasdaq 100. That's where the money supply is expanding. That's where the inflows are. And you will underperform the S&P 500. And, I feel bad for you because you have a large position. You have 600K. Dude, if you had listened to me, I can guarantee you this 100%. You would have been a lot richer. But, you do not understand reality. You think in the fantasy land of money, of fucking companies. Well, the reality is casino tokens and flows. That's all there is.
All right. Well, we're at an hour and a half. Let's do some super chats, and then we're going to shut this down.
Okay.
Oh, I got gifted a membership. Thank shout out to all my members, including you.
Yeah, I'm also a member. It's I like your videos. Let me say this for the record. Please, everybody, tell Strongman to make more videos where he shits on scammers and grifters and stupid people. Those are the best ones. I love them. They are the best entertainment ever.
Well, you got to pay for it, boys. All right, we got Antonio Miranda for 11 euros. Looks like the money's flowing to me here. Global M2 money supply goes to 8 to 10% per year on average. Global CPI is around 2.5%. You need 10 to 12% returns to break even. Two investments that beat it. Tech and Bitcoin. That's it. It's just
he doesn't think correctly. It's the S&P 500 and the Nasdaq 100. It is the ETFs and mutual funds with most assets under management. That's where you get the inflows. That's where you get the money supply expansion.
Okay. Strongman, sell this guy your DCF calculator. Yeah. I should think if I made a fund flows calculator, would you buy it?
Dude, I can just go Google the ETFs with most assets under management. What do you mean?
Okay. You'd buy it. Come on now.
No, fuck.
Narrative. With Trump, foreigners will dump U.S. stocks. Fact. As of May 2025, percent of foreigners holding U.S. stocks hit an all-time high of 35% plus. Learn.
There you go. Thank you very much, Antonio. I love you a lot. Thank you, my friend.
But then again, maybe U.S. investors are flowing in international stocks. I mean, international has done pretty good this year. It has.
You will feel very
that's
bad.
That's where the fund flows are going. You should ride that wave, bro.
In 5 years, you will underperform the S&P 500. I will guarantee you that. Right now.
I don't care. I don't care.
Okay, then keep underperforming. It's your choice.
Okay. Okay. That's fine. I'm always gonna underperform something. That's the
But
that's the index life, bro.
We are not talking about stocks, Nvidia. We are talking about index funds. Okay, stop making that argument. You will underperform the S&P. It is the most popular index fund. This is where the money flows go, and you are not part of it. You are diluted in trash international.
We'll see.
Yeah, we will.
Bitcoin is already larger than QQQ.
Well, QQQ is concentrated S&P 500, and S&P 500 is the largest. So no.
Okay, I think you're gonna buy Bitcoin at some point.
No, never, ever, ever. Not one chance ever.
Why? How is Bitcoin different from stock casino tokens?
Well, they are the same. They both run on the buy and sell button. Now the difference is the company can buy back shares, which is good for positive return, but that's pretty much the only difference. Now, what I will do is I will look at the ETFs and mutual funds with most assets under management, and given that the financial industry runs the 401ks and the mandates of the pension funds, it will continue to be stocks, okay? Because crypto doesn't produce anything. Companies produce things, so it's better to have the inflows on their casino tokens. That's better for...
Oh, so the stocks are better casino tokens.
Yes, correct.
Okay. All right, well, that was a good, hearty debate. I appreciate you coming on. Thank you to all my pay pigs. Last comment. Let's go. We
Can we do 5 more minutes of comments, please? It's very good. I like this. Just 5 more minutes of comments, and then we're done.
4 minutes.
Okay, thank you.
All right, well, what comments are there any particular comments you want to address?
I do not see them. Just bring up the ones that talk about the money flows. I love those ones. Do it for your audience. Your audience makes you money. Come on, do it for the audience.
There you go.
Yes. So assets under management is inflows because there is zero money in there. When you see assets under management, you see basically how much money is flowed because there is zero money in an ETF. There is only money in bank accounts in the banking system. That's the only place where money ever is, or cash, which is very small part. So when you see assets under management, what that actually means is the flows of money. And that's where the inflows are, and that's where the money supply gets captured. So assets under management is inflows. The more assets under management, the more inflows, and that's what goes up forever. And that's where you can take leverage responsibly. Okay, the joke is the USD, Euro, Yuan doesn't matter. As long as stocks are priced in USD or other currencies and money supply increases, stocks go up. That's true. That's why the money supply is also a reason why the S&P 500, the Nasdaq 100, and VT will go up forever too. But VT is diluted, so it will go up less, basically. So that's how you capture the money supply, by being in the index funds. That's how you do that. And the S&P 500 is the original inflows, and the Nasdaq 100 is the concentration of inflows. That's the best ones.
All right. Let's see. Oh, here we go. Here's a good one.
Does most passive extractor have a YouTube channel? He's actually pretty good and sharp. Yes, of course, my friend. I will show it to you. How do you want to show my YouTube channel? Go and search it up real quick if you want. It only has 3 subscribers. Don't worry. I'm not
I don't know it. Just pull up your channel. I'll show it.
Okay. 1 second. I'm gonna go.
I need good content to react to for members.
Yes. Yeah. Let's do that. I would love that. I have some videos actually we can react to. Wait. Let me show you my YouTube channel so you can view this. Okay, so let's go ahead, boys. My YouTube channel is the most passive extractor. And you can see this is this one, the top one. And we already have a couple of... Stop laughing, dumbass. Okay, so we have here my channel. Basically, if you search the most passive extractor, it's this one. And I have... this is some important videos. This is also a debate I did with Tan Liu. Tan Liu is from the Ponzi Factor. He proved the stock market is a Ponzi scheme based on flows of money. And here I debated him based on total return, where I proved that dividends are a scam. So here it is 2 hours. Here, the most passive extractor, reality introduction. This is actually, the video should be renamed to how to find the inflows. This one, the most passive extractor, reality introduction. This is the video where you can see how to find the inflows and how to profit from the money supply expansion and the guaranteed inflows. Here you see the importance of never being around retards, because online there are a lot of traders, options gamblers, all these retards. It's important to not be near them. And here you have more casino token proof. So I would recommend everyone who is interested in the absolute reality here to watch these videos as well. If you have time, if your wealth will benefit from this, I'm 100% certain.
All right, one more comment.
And I'm going to end with something else.
Oh, we got him. Damn, I'm farming super chats here. I gotta take a piss again. Here, you can read this.
Yeah, let's keep doing this. By the way. Okay, so when was the
Well, we're gonna go until the super chats dry up, and then
okay. Okay. When was the world better? 2025 war tariffs or 2019? 2019. Yet the S&P and Nasdaq is like 3 times higher. Flows and liquidity, all that matter. There you go, Antonio, my friend. You understand the system. So yes, it is true. The stock market is based on 2 things and 2 things only: the money supply and the participation. Now, the participation is more important because, as we saw with China, as we saw, the money supply of China grew a lot more, but their stock market is flat compared to the thousands of % of the QQQ and the S&P. So this means that you need participation. That's why the USA will outperform forever, because they have the 401ks, they have the Roth IRAs, they have their whole pension system inside the money flows casino token markets. And that's why the returns are highest in America. And that's why the returns will always be the highest in America, because that's where the inflows are, and that's where you capture that money supply better, right? That's where all the money supply expansion from all the different currencies get captured better, because that's where the most money supply, that's where the most money flows between bank accounts. That's all that happens in the stock market. Money flows between bank accounts. That's the only thing that cash ever does. Money only flows. And the S&P 500 is the flows, and that's where you will outperform. And if you take leverage, you will be extremely wealthy, but responsible leverage, 2 times maximum or 3 times with DCA. There you go.
All right. Anybody else want to feed my insatiable desire for money?
Yeah, compensate for the underperformance.
Yeah, I need it. I'm really desperate.
Yeah.
We'll give 2 more minutes. If we don't see another super chat, we're done.
Maybe take one comment. Okay, so I want to end this with the most important point, Strongman, out of this very important reality discussion we have had. Participation is everything. This is why USA will outperform, because unlike other countries, so basically other countries around the world, they do not have their retirement systems built into their stock markets. So that means they do not have the participation. They do not have enough money flowing around in their bank accounts around the stock market. And that's why the returns are lower. Because, Strongman, money is in the banking system always. The only thing that money does is move from one bank account to another, to another, to another. So basically, you need participation for that money supply and the flows of money in bank accounts to take part in the stock market. And Strongman, what you are doing with VT, you are guaranteed to underperform, because they are not flowing the money in the international casino tokens. They are not doing the flows there. The flows are done in America, on the S&P 500, on the Nasdaq 100, on the total US market. You are guaranteed, and I'm sorry, but this is the reality, you are guaranteed to underperform the S&P 500 forever, as long as the system is as it is, and it will remain as it is.
All right. Well, that was a good debate. Thank you, everybody, for tuning in. Thank you for all the super chats. And I'm sure we'll be debating again in a couple months, because you're going to miss it.
No, Strongman,
Yeah,
I'm not getting extracted by you anymore. Don't
If
worry.
this video gets taken down, you're sending me $100.
Yeah, if it is, but it won't. So whatever. Also, everybody, just a reminder. I'm still. Can you show my screen again, please? 1 more minute.
Oh, hold on. We got a super chat. This guy's, man, I'm milking this dude. I love this.
Antonio, you are gonna make this money back with Nasdaq 100. Believe me.
Sorry.
That's true. It's the concentration of the inflows. Of course, he will. Okay, why liquidity needs to be pumped? No liquidity, assets fall, collateral falls, debt falls, bank defaults. Antonio, you are smart. Antonio, what's your Discord? I need to talk to this guy more. He knows, man.
You guys should do a live stream together.
Yeah, we could talk together. Antonio,
I've seen this guy on my channel a bunch. He's OG.
Okay, Antonio, go into Discord. I send a chat now. Antonio, where are you? There you go. Message me. Also, what I'm gonna do for everybody here, I'm going to post my YouTube channel in general in Strongman. Of course, I only have 3 subscribers, so don't worry, I'm not a YouTuber like you. So go and watch reality. There is a lot of reality there, so you can put it as a podcast when you have time. You can watch it, Strongman, if you want to learn more reality from somebody who actually understands the money flows.
I'm gonna watch all your videos right after this.
I mean, you should. You will see reality, my friend. You will see that. So you should. But you know, I will feel bad for you, to be honest, because I know, and this is not chance. This is not gambling. This is not like Nvidia or Palantir or whatever or Bitcoin. This is index funds only, and also strongman. I am for index funds only index funds. And the reality is, you will underperform the S&P and the Nasdaq. It is guaranteed, and I will feel bad for you because you have so much money. The opportunity cost will be massive. But then again, that's not my problem, is there? So
maybe I just like being poor.
Yeah. Oh God, Antonio! No! What the fuck is that? No, sell your crypto. I mean, look at the ETFs and mutual funds with most assets under management. It's not fucking crypto, okay? It is the stock market, and it will always be the stock market because the financial industry runs the 401ks and the Roth IRAs. The pension funds are basically created by universities who are influenced by the financial industry. And believe me, also the government. Look, companies, their casino tokens on the stock exchanges, they can get money to innovate and do things. Crypto doesn't do shit. Crypto doesn't do anything. So, of course, it will always be the stock market. It will never be crypto. I will never touch crypto ever.
I can agree with that. I like that.
Yeah, it's reality, man. I am very reality focused, as you can see. And I hope, Strongman, look, Strongman, let me tell you something out of my heart. You have given me a lot of value because of you, I have not fallen to a lot of scammers on YouTube. And I want to thank you because you destroy scammers, and that is needed. We need more people like you. We need a lot more people like you. So you bring a lot of value because you destroy scammers. And, you know, I hopefully, look, Strongman, sometimes I'm mean, but I really like you. I really like you as a person because you are here for reality. Of course, you do some grifts with your company analysis for $50, which is meaningless and doesn't matter because I'm never buying a stock because that has no inflows. Also, a big difference between an index fund and an stock is the index fund, the S&P, has guaranteed inflows, and the inflows of the casino token stock are based on the company, which you cannot predict the future. Who knows what companies are going to do? It's impossible to know. So you need to be in the guaranteed inflows. If you want higher returns, you leverage the guaranteed inflows. That's how you get higher returns. Of course, responsibly, of course. Don't over leverage because then you get wiped out in the next crash. You want to survive all the crashes, all the ups and downs. So that's why 2x is optimal, not 3x. 3x is more advanced. It's a bit more complicated. Generally, just do 2 times the S&P 500. You'll be more than okay. The best ETF for that is SPUU, ticker symbol SPUU. If you buy that, that will outperform a strongman forever, basically. But you know, he won't buy it because he doesn't know. He doesn't know reality of the inflows. So yeah, man, I just want to say, Strongman, I like you a lot. Please make more videos destroying grifters. Those are the best, and that's what I'm paying for, by the way. If you did not make those videos, I won't be paying those $5. So, you know, that's where you bring the most value. And that's why, Strongman, the reason why you are Strongman is because you made those videos destroying grifters. That's what made your audience. That's why people watch you. And that's why I watch you, actually. A lot more interesting than those videos where you shit on Trump or talk about Elon Musk. I don't really care about that. I care about seeing grifters get shit on. Also, Strongman, you are a very funny guy, and I laugh a lot when I watch your videos. And, you know, you bring a lot of value to me in that sense. And also, you are the first person to teach me about index funds. So thank you. And because you made me who I am, and I just want to give a bit back to you. You know, I gave you some money, but hopefully you can see the reality of the money flows, and you know, at least do an S&P 500, at least do a VTI, man, because you know, compounding over a long time, that will make a big difference in your net worth. You know, we're gonna see in 10 years at the end of the day, and you're gonna think back on this. Yeah, I should have went into the S&P or the VTI. I'm not telling you to do Nasdaq 100, even though the Nasdaq 100 is basically concentrated S&P, and it will outperform the S&P and VTI forever. You don't need to do Nasdaq, but just know the reality of the money flows, man. That's all you need to do.
I appreciate it. Oh, we got another super chat. I'm farming here.
There you go, Antonio. Antonio, I want to talk more to you. Okay, go ahead.
Oh, you can read it.
Go okay, liquidity is water. Stocks is a swimming pool. Crypto is a bucket. That's all, friends. Bitcoin tracks global M2 with 100. Okay, dude, shut up. Look, Antonio, you are wrong because crypto is not where the money flows are. Crypto is hype. Crypto is FOMO. Crypto is nothing. Okay, man. If you look, you need to go. Look, if you want to capture the money supply, you need to go to the ETFs and mutual funds with the most assets under management. And that is the S&P and the Nasdaq. That is not crypto, man. Come on. We got
another one. This guy is,
nice.
Man, he must be a Bitcoin millionaire because he's just tossing money around like it's water.
I love Antonio, but crypto is trash. What destroys a man? 3 leverage, liquor ladies leverage. That's true. Leverage, over leverage is bad. So maximum is 2 times to 3 times. Also, very important to understand, every scientific paper that's been ever published shows that passive investing outperforms active. So you want to be basically 2 times leverage daily, but be a passive extractor always. You want to be very passive always. Passive investing is reality investing. That's for the best returns. Passive investing is high return investing. Active investing is low return investing, basically.
All right. Is the free money rain drying up?
Yeah, Strongman. You know, this debate has been very valuable to me, because what I will do now, Strongman, so in this video we have made a lot of points of reality. Antonio has contributed a lot, so I want to thank Antonio, even though he's a bit stupid with the crypto, but I think he will get out of that with time. So, you know, because the money supply tracks crypto, I guess, but tracks the S&P 500 more. So why would you go in crypto? Crypto is nothing, man. Crypto is worthless shit, as we know. So,
Man.
Listen, let me read. When FTX went bankrupt, Strongman made a video making fun of it. Bitcoin was 16K. I made a super chat saying, "This is your chance, boy." Antonio, this is the same for the Nasdaq. This is the same for the S&P. What's the difference between the S&P and the Nasdaq and Bitcoin? Fucking S&P and Nasdaq is guaranteed to go up, but the Bitcoin is fucking not. Once the hype goes away, it goes away, man. It's nothing. And the retirement system is where the inflows are, and that's going to be S&P. That's going to be the stock market. Okay? Look, the world and the society is going to be more productive if the money flows into the stocks instead of fucking crypto, because crypto does nothing, while the stocks, the companies, they do everything. Okay? The companies do everything on this world. Of course, the inflows are going to be into the companies, into their casino tokens, not into the crypto casino tokens. They are all casino tokens, I agree, but I care about where the flows are going, and structurally, it is not crypto. So get crypto out of your head. Crypto is retarded. Go with the inflows, with the ETFs, with the mutual funds, with the index funds. That's where the inflows are, not crypto. S&P 500, Nasdaq 100. That's where the inflows are. The S&P 500 is the original inflows, and the Nasdaq 100 is the concentration of the inflows, and the Nasdaq 100 will outperform the S&P 500 forever, and this is not hype. This is structural reality, and crypto is gambling. It is very possible in 5 years, crypto will be down 90%. It is very possible. Nasdaq 100, not possible, unless the world ends.
All right, well, Antonio, come on, bro.
Yeah, I mean, I like this. So let's just.
This has been a very profitable stream.
Yeah. You see, Strongman, and also if you switch from VT to S&P, it will be even more profitable. But you know, that's your money, man. I cannot do anything. I can just show you the reality. What you do is your life. You could also just go 10x leverage in Bitcoin. I guess you can do anything, but you know, you should do S&P 500. Just know reality, man. It will go up forever. You're missing out, man. You have missed out so many years already, man. That's what you do. That's what you get when you are not in the inflows. You get underperformance. That's the reality. And the inflows, as we see, ETFs and mutual funds with the most assets under management, because that's where the flows of money happen between bank accounts, right? That's where all the bank account shuffling goes, where the most assets under management are managed, buying and selling. That's all there is. That's all there is. Nothing else. So yeah, and also fuck crypto. Crypto is trash. Everything is trash. Commodities are trash. Real estate is trash. Everything is trash when you compare it to the inflows of the S&P 500 and the Nasdaq 100. And when you compare 2 times the S&P 500 and the Nasdaq 100 to everything else on earth, I will say this, and this is so important to say: 2 times Nasdaq 100 and 2 times S&P 500 will outperform everything forever. You prefer a 10 times to a 2 times? What the fuck? Man, this guy's a gambler. Yeah, I mean, come on, man. I'm talking about reality here, and you come up with 10x leverage. What the fuck? Yeah, I mean, come on, man. You are gonna kill yourself if you do that. So basically, that is also a rule. Never go above 3 times, ever, in any circumstance. Even in quantitative easing, you don't do that. Even in quantitative easing, which means it's guaranteed to go up now in a straight line, you don't take over leverage. Because, the reality is, strongman and everybody, you have to protect your wealth, right? When you have it, you have to protect it, right? So that's also why strongman, with your 600K portfolio, I would not go all in 2 times S&P or 2 times Nasdaq. You should split it a bit, have like a leverage of 1.5, because the system is guaranteed to go up forever. So when you leverage it responsibly, you just go up more. That's it. Also, 2 times VT is very applicable, but still, that will underperform 2 times S&P and 2 times Nasdaq. So gotta think about that a bit.
All right. Well, I guess my infinite money pot is dried up. So
yeah. So let's just finish this with look, strongman, I like you a lot, so please keep destroying grifters. I'm gonna feel bad for you because you will another one. Okay, Antonio.
Is this real? Is this really happening?
Antonio, Antonio, I am very disappointed in you because you came into this with the reality of the money flows and liquidity, and now you're talking about Bitcoin being good or something like that. Look, Bitcoin is hype. You do not bet on hype, okay? You bet on structure. I am betting on the 401k system, if you want to know what I'm betting on. I am betting on our 401k retirement system, and that thing is guaranteed to keep existing. Okay, let's see. Bitcoin is 10x natural leverage. Oh, God, fuck me. That was the most retarded thing I've heard. Okay, on Nasdaq. I prefer 10x returns versus 2x returns. You don't use leverage. Okay, so this... Okay, Antonio, I thought you were smart, but you are not so smart. So this not so smart individual is saying that that the Bitcoin is natural leverage. No, it isn't, man. It is hype. It is fucking hype. It is not. It is not based on systems, man. It is not where the 401k goes. It's not where the Roth IRA goes. It's not what. Bitcoin is hype, man. It's so stupid. Because you need to understand, it is very possible that in the next 10 years, Bitcoin will go nowhere. But the S&P and the Nasdaq not, because that they capture the money supply better. Also, so Antonio, you are a fan of the money supply and the liquidity, which is the reality of everything. But then you go Bitcoin, that's not where the liquidity is. That's not where the money supply expands. It's in the casino stock market that it does. Okay, so you need to go for index funds because you have no certainty with Bitcoin, zero certainty. The certainty is in ETFs and mutual funds with most assets under management. That's where the certainty is. That's where you can take leverage and outperform everything. And that's where the money supply expands as well. Do we have another one?
I don't see another one. So I guess Antonio ran out of money. Well,
yeah, we'll make it back if it stops with the crypto and goes into Nasdaq, man. That's true. I mean, I'll make my money back as well. I mean, how old are you? You're 35. So I am 21 years old and I have 30K. With my compounded annual growth rate, which I assume it will be above 20% at a minimum, while with VT you are 7%. I mean, I will at 35 I will have $1 million, very possible. So, as long as
wait, 100 million. You think you're gonna have 100 million bucks?
1 million.
Oh, 1 million.
I mean,
okay.
Yeah, you could adjust it for inflation, very possibly as well. Also, another important point to make for everybody. So most businesses go bankrupt. Real estate has trash returns. We know real estate will underperform the stock market forever. That's a given. That's guaranteed as well. So given that, at this point, we got to keep this live stream going. Yeah, I mean, strongman.
Hey, I'm in farming mode now.
Yeah, but not only that, strongman, but this is a very, very big reality that we are discovering here. I think you agree, right? At this point,
I'm totally convinced.
I mean, stop being sarcastic for 1 second. I know you're a funny guy. I like that about you. But we have some reality here we have to look into deeper.
Well, I mean, you think I'm going to admit that you defeated me? That's for the audience to
I
decide.
really look, strongman. We need to stop thinking in this like I defeated you or not. We need to see what is the reality. Look, strongman, I am not here to defeat you. I like you. I like your YouTube channel. I want it to grow more. I want you to make the best videos, destroying grifters. I like that. I want to show you the reality. I want to give back to you because you destroyed grifters, and I love that. I want to give back to you, man. And look, it's your life. Okay, I don't care what you do with your money, but you need to know reality. That will help you a lot. So the ETFs and the mutual fund with most assets under management is the inflows, and that's where it will go up forever, guaranteed. And that's where you can take leverage. That's where you will outperform. You are diluted. You are not in the inflows. You are diluted, and that's not good for your returns.
Interesting. What's Ron? You know what Ron is?
Romanian. Sunt eu Român, by the way. Sunt Român. I am Romanian.
Oh.
Yeah.
Interesting.
Yeah, but I live in Belgium, so.
Oh, you're an immigrant?
I've been living here for 13 years, so I guess I'm more Belgian than Romanian now.
Got it.
You got another one?
Thank you for the 10 Ron.
Yeah, that's like $2, so.
What? That's it? Okay, we got Mr. Seymour Duck. Thank you for the duck. Man, is this the key to getting rich on YouTube? You just sit here and just farm super chats?
We got another one?
Multiple streams of grifts.
I mean, this is not a grift, you know, and that's a problem with Strongman. He does those like company balance sheet reviews. Like, who gives a fuck? I mean, that's not where the inflows are. And that's also, I am very against individual stocks. Individual stocks are gambling, and 96% of them underperform the index. So don't touch individual stocks ever. Don't touch crypto. Don't touch anything except the S&P 500 and the Nasdaq 100. Also, I've just seen here on our Discord from DGen, I am more convinced about Bitcoin after listening to this debate. I mean, this guy's stupid. I just said Bitcoin is not the inflows. Bitcoin is hype. Crypto is hype. The inflows is the ETFs and mutual funds with most assets under management. The inflows are where the 401ks and the Roth IRAs go make their inflows. That's where it is. It is not Bitcoin, okay? So yeah, he's gambling. He's stupid.
All right. I think that might actually be it, everybody. All right. Well, thank you for tuning in. Everybody have a wonderful weekend.
Okay, Strongman. Can we talk like 2 more minutes after we end this? Just a little bit?
Sure.
Okay, thank you. Thank you very much. So, okay.
Bye-bye,
everyone. Make sure to concentrate yourself in the inflows and outperform VT forever.
All right. Goodbye, everybody.